What if holding on to cash is the most dangerous financial mistake you can make right now? Ray Dalio, one of the world's leading investors, says something shocking. Cash is trash. He believes that clinging to cash and traditional investments could strip you of your buying power and leave you financially exposed in today's economy. But if cash is trash, what should we be holding on to? And how can you truly protect your wealth?
First thing is you realize that holding cash and dead assets is a bad thing. So a lot of money is in cash because people think that cash is the safest investment, but they are measuring that in amount of money that they get, nominal returns, and they say it doesn't wiggle much. But think about it. It's lost, as of the most recent statistics, 8.5% over the last. Inflation is 8.5%, and they receive virtually no interest rate in cash. And so there was an 8.5% loss of buying power as a result of inflation. And so psychology should change, and is in the process of changing, to realize that you have to think in terms of buying power, not the number of dollars you have. And you have to think how much is your buying power. And so the worst thing is to be in cash. Like I say, cash is trash, and to be into and to be out of the bonds. The next thing is to have a diversified portfolio of assets. The diversification means some assets that are inflation hedge prone. For example, you're better off to own an inflation index bond than a regular bond. Yes, and inflation index bonds because their returns are tied to inflation. I think the punchline is, if you take a look at it, it's simple. It's like a regular bond, except its payments are linked to the inflation, so they compensate you for inflation. And there are some tax advantages to them too. So look into them. Well, I think it's one type of asset. The flooding into any one thing is an issue, but moving from the nominal bonds, in which the government just says, I'll give you this amount of money, and it has the unbelievable and unlimited ability to print the money it gives you, it would favor inflation index bonds. And it could be other assets. Some people would say something in terms of cryptocurrencies, or it might be those other assets. I think that too much people pay too much attention to one at the extreme of the other, that either somebody's all crypto, or they're all gold, or they're all something. And I believe that that's a challenge. I think that crypto, like gold, is not a productivity earning asset, and it can be controlled by governments in lots of ways. It's been outlawed in a number of places, and it also can be monitored. The privacy element is not secure from governments doing monitoring, and so the size of crypto is about the size of Microsoft. It's all crypto combined. And so to be overly concentrated in it, in my opinion, is a mistake. But to have some of it is a good thing. So the question is always, what amount of it? So that's, I have a little bit about it. I'd probably shock you about how little I have. You would shock me about how much you have, but having some of it. So, and other things I would say is that geographic location is important. In other words, not just all in U.S. and U.S. dollar assets. I would say that the three things that again I'm looking at if I go down countries is, first, are they earning more than they're spending? Do they have a good income statement and balance sheet? This is going to be very important in the period ahead, because the amount of credit that's going to be available to bridge the gap between spending and earning, cash flows and so on, is going to be quite narrower. So a lot of companies even that we're able to raise cash and not have good cash flow because of maybe growth expectations in the future. We'll find it more difficult. That'll be true for individuals. It'll be true for countries. So does it have a good income statement and balance sheet will be important. The second is places. How are they working with each other? Is there civility or is there civil war, on the brink of civil war? Because countries where they work well together, they're productive, are going to have a real competitive advantage. Orderly places, safe places to be.
Ray Dalio's perspective offers a deeply pragmatic approach to personal finance in a rapidly shifting economy. His insights challenge traditional ideas about what it means to invest safely. The common mindset that cash and bonds are secure assets is being flipped on its head by Dalio's analysis. According to him, inflation erodes buying power, so cash held without any returns is like watching your wealth dissolve slowly. His advice to diversify beyond cash and traditional bonds, especially into assets that hedge against inflation, urges us to think differently about wealth preservation. Dalio also emphasizes the risks of concentrated investments, whether in cryptocurrencies or traditional US assets, given the global economic landscape. His advice on geographic diversification highlights the importance of seeking investments in financially and socially stable regions around the world. Finally, he suggests that individuals prepare for tighter credit and economic conditions, where assets held in stable environments are more likely to hold their value. Ray Dalio's approach is a wake-up call for individuals looking to safeguard their wealth. He's essentially urging us to reconsider everything we've been taught about safe investments. With inflation on the rise and economies growing more uncertain, traditional assets like cash and bonds are no longer reliable on their own. Instead, Dalio advises building a portfolio of inflation-protected assets, a balanced approach to cryptocurrencies, and geographically diverse investments in stable economies. His message is clear. In a volatile world, financial survival and growth require adaptability, diversification, and a global perspective. So what practical lessons can we take from Ray's comments? 1. Shift your mindset. Focus on buying power, not just dollar amounts. Inflation can erode your savings value without you even noticing. To combat this, stop thinking in terms of how much cash you have and start thinking in terms of your buying power. What can your savings actually buy in today's economy? With inflation running high, cash loses value quickly if it's not earning anything. Inflation is a gradual, often invisible force that reduces the real value of cash over time. When inflation is high, the purchasing power of your savings decreases, meaning that the same amount of cash buys fewer goods and services as time passes. For example, if you have $10,000 in savings and inflation rises by 5%, your money's buying power effectively drops to $9,500. This loss in value occurs even if the dollar amount remains the same, which can be deceptive. By shifting your mindset to focus on maintaining or increasing buying power, you start to look at cash as a dynamic resource that needs active management, rather than something that holds its value just by sitting in an account. Cash that sits idle in a low-interest savings account or in a rainy day fund without an inflation hedging strategy is essentially losing value. In today's inflationary environment, where the cost of goods and services increases faster than most standard savings account rates, this lost value can be substantial over time. The opportunity cost of leaving cash idle means you're forfeiting potential gains that could keep your wealth in line with or ahead of inflation. By understanding this cost, you can begin to take action by exploring alternatives that provide better protection against inflation. So consider moving idle cash into investments that have the potential to keep up with or outpace inflation. 2. Diversify your portfolio across inflation-protected assets. With Ray's recommendation to avoid staying in regular bonds and cash, consider reallocating part of your portfolio to inflation-protected assets. Inflation-indexed bonds, for example, adjust their returns in response to inflation, helping protect your buying power. You can also explore assets like real estate, commodities, or specific stocks that perform well in inflationary periods. Diversification helps you stay resilient against the impacts of inflation end economic instability. 3. Don't rely too heavily on any one asset class or country. Putting all your money into one type of asset, whether it's stocks, bonds, or even cryptocurrency, carries risks. Dalio advises against concentrating on a single investment, even if it's promising in the short term. Spread your investments across asset classes, including stocks, bonds, commodities, and if you're interested, a small allocation in cryptocurrency. Additionally, diversify geographically by investing in international markets, especially in stable economies, to avoid over-reliance on any one country's financial system. 4. Prepare for tighter credit and economic conditions by managing debt carefully. With Dalio's warnings about tightening credit conditions, make it a priority to evaluate and manage your personal debt. Focus on paying down high-interest debt, as interest rates may continue to rise. Limiting your debt and maintaining strong cash flow will give you financial flexibility during economic downturns, when access to cheap credit may be more difficult to obtain. In periods of tighter credit, it's beneficial to review your entire debt portfolio, which may include mortgages, personal loans, credit card balances, and any other liabilities. If you have multiple high-interest debts, consider consolidating them into a single, lower-interest loan to simplify payments and potentially reduce overall interest costs. This strategy can also make it easier to track and manage your debt payments. Consolidation may only be an option while credit conditions are still moderately flexible. So assessing this early can lock in lower rates before they rise further or access becomes limited. When preparing for tighter credit conditions, consider prioritizing paying down variable rate debts before focusing on fixed rate obligations. By reducing or eliminating these variable rate liabilities, you're protecting yourself from the risk of escalating payments, which can help stabilize your cash flow and improve your financial security in a high-interest environment. 5. Invest in stability. Choose investments in financially and socially stable regions. Ray emphasizes the importance of choosing regions that are economically and socially stable. Countries or regions with low levels of internal conflict and sound financial practices are more likely to withstand global economic shocks. Look for investment opportunities in countries that have low debt, high productivity, and political stability to reduce risk in your international investments. 6. Rebalance your portfolio regularly to reflect changing economic conditions. Markets and economies shift, and so should your portfolio. Ray Dalio's advice emphasizes adapting to new economic realities, including inflation and global conflicts. Rebalancing your portfolio, such as adjusting your mix of stocks, bonds, and inflation-hedged assets every 6 to 12 months, helps to ensure your investments stay aligned with current market conditions. Regular rebalancing also prevents overexposure to underperforming or high-risk assets, helping you remain agile and better protected against market downturns. 7. Build a cash reserve, but don't over-rely on cash. Although Dalio warns that cash is trash due to inflation's eroding effect, it's still wise to keep a small cash reserve. Aim to have at least 3 to 6 months worth of living expenses in cash or highly liquid investments to cover emergencies. This approach balances the need for liquidity with the reality that cash loses value over time. The key is not to rely on cash as a long-term investment, but to see it as a short-term safety net, with the majority of your assets placed in more productive investments. If you don't own your future, someone else will. Start thinking differently about your wealth today. How do you currently protect your wealth from inflation and economic uncertainty? What changes, if any, do you plan to make to your personal finance strategy based on the forces Ray Dalio describes?